Yra Harris. Good morning, Ira.
Good morning.
How are you?
I'm okay. How you doing?
I'm all right. I'm blind. Hey, happy haircut. And look at that tan.
Yeah. You walk outside at 6 o'clock, you get 10. Yeah, I'm sorry about your eyes. What the hell's going on?
A year ago, I got this thing called uveitis. Uveitis is inflammation of the eye. And it's a really rare disease. And I had a rare form of it, or I have a rare form of it. So it causes inflammation of the inner eye, which ends up causing cataracts and glaucoma. It can, my retina so far is fine. It hasn't detached, but it could cause that. So I've gone from 2050 sight to 2000 to 2080 to 2000 to 2200. And now I'm someplace in between 300 and 400, which meets the 2200 meets the legal criteria for being blind. So I've, in my left eye, my right eye has got beginnings of cataracts and glaucoma, but it doesn't seem nearly as affected as my left eye. And that's the great news. So I can live with one good eye. Friday, I have, I'm going to have 2 procedures done. They're going to remove my cataracts. So that will restore most, if not all of the vision for now. I'll get another flare up that always causes inflammation anyway. And so I'll get a flare up of the uveitis. At the same time, they're going to put in a drain in the back of my eye that I'll carry like a medical card with now, to explain to everybody I've got an implant that will help drain it to keep the eye pressure low so that the glaucoma doesn't continue to grow rapidly and spread. So if they can control the glaucoma and the cataracts and then treat the uveitis as it flares up, then I should be okay.
Okay.
So it's been a crazy, it's been a weird, it happened about a year ago. It started a year ago. And the last month has been crazy since I've been seeing these, my specialists at Northwestern. It's just been an odd time, odd things going on.
Okay. Well, let's get through them and then
Amen to that.
celebrate something.
Amen. How are you?
I'm okay. Hanging in there. Hanging in there. Yeah.
How's by you? How's it going?
Everybody's good. Good. Everybody's good.
How's Sturch?
I talked to him about 10 days ago. He's doing pretty well. His brother passed away, so that's good. So yeah, that was pretty hard. So outside of that, I think everything is actually pretty good. So knock on our heads, so to speak.
Knock on mine anyway.
So really nothing else. Did you have something in particular you wanted to
Ira, I wanted to ask you if you could add some color to the implications you see with the Fed reducing the size of the balance sheet right now and into these 50-point rate hikes. If you could add some more clarity and kind of what you see happening with the amount of balance sheet reduction that they have to do and what implications that has with the amount of 50-point rate hikes that they potentially have to.
I just sent Matt a piece to post. I think it's a good read. It probably explains it far better than what I'm going to do here. But in today's minutes, I won't even be here for them, but I'd be looking for to see what they say about this. Because my first question is, and it should have been asked, although I know that people tell me Nick Timrose asked it in an interview of Powell last week, why didn't you begin quantitative tightening QT right away? What'd you wait till June 1st for? And when Powell was briefly asked that question, his answer, well, it's just a calendar date. To me, that was a really pathetic answer, because if you were so concerned and you're trying to understand what the hell is actually going on here, you should have begun right away. Now, again, I thought they should have begun with 95 billion, of course, for June, July, August, for I think 3 months or maybe through 4 months, they're just going to be at 47.5, because they really need to see how this is going to work. The half-point rate rises again, because you're still so far from quote unquote, whatever neutral is. Again, it's an amorphous, really undefined term.
Yeah.
We know it when we see it. It's true pornography, but I don't. They don't tell you what it is. Is it a tailor? You know, so nobody knows. So I hear that word quite thrown around quite a bit. My concern, and the piece I just sent to Matt, which he can distribute,
Copying it now.
is that quantitative tightening bears a phenomenal power in this market because of the huge amount of leverage that exists in the system, all fostered by the Fed, by the way. You know, let's call it what it is. You know, this liquidity, on top of liquidity, even though the crisis seemed to have been gone long ago, and the Fed kept building up their balance sheet, and not only the Fed, the ECB and the Bank of England, and so you had a massive amount of liquidity flowing in the system. Now, as this piece points out that I sent, everybody is now going to quantitative tightening. Now, just how leveraged is the system? We don't know. We can conjecture and we can anecdotally come up, but we really don't know that answer. So what the impact and how immediate and how devastating is it going to be as you get deleveraging? Because right now, to me, all the risk off that you're seeing, and I'm really not a fan of that phrase, but we're kind of left with it, is a deleveraging that's taking place in the entire global system. And that, again, and I know I've discussed with this room, is that it begets the question, let me step back for a minute, because Powell was quick to give us an answer about what the equivalencies of, well, a year's worth of quantitative tightening, he said would be 1/4 of a point of interest, but he said, I wouldn't really run with that. Okay, all right, because again, we don't know. But what is a 14% increase in the dollar? What does that mean for a system levered up in borrowed dollaring? And nobody asks that question. It's really, the media just likes to hear themselves talk. They don't do enough asking of real questions because they come predisposed and they don't, and there's no flexibility. Because again, 10 of the 13 questions, I think, at the last press conference were just an iteration on a theme and nothing more. And they don't take anything anywhere. But the rally in the dollar, to me, has played havoc with the amount of global risk that's on, because interest rates going up matters to them because a lot of them have floating rates. And number two, the cost of paying back those dollars matters greatly too. Now you can say, well, maybe they're hedged. Yeah, but when, funny thing about market participants, where you and I might do something like put on our hedges because with ultra low volatility, we say, whoa, this is pretty smart. A lot of people, after they've spent 3 or 4 rotations of buying, of paying for hedges, they go, you know what, the markets aren't really doing anything. And then they have their CFOs figure out, well, how big a move until our business is really affected. So you get all types of responses because nobody wants to keep paying away fees when nothing is going on. And we've had 2.5 pretty solid years, 2 years anyway, since March of 2020, of interest rates being really stuck to the floor and a lot of low volatility for the most part. So people don't really hedge themselves. So there's some really big risk pools out there. And then you throw into the losses that have been sustained in the global bond markets, no thanks to the central banks yet again, right? Because they're the ones who certainly created this situation, good, bad, or indifferent. It's just a fact, by the way, because they forced people to buy bonds who needed to buy bonds to pay outrageous levels. Everybody talks about the Austrian 100-year bond in which people have gotten decimated. Yeah, so these are all out there, and how much is leveraged, and we don't know, and the Fed doesn't know either, and the ECB doesn't know either, but they're going to find out. And we found out, we've walked this road before. For those who say we haven't, if we go back to 2018, we have certainly been in that situation, and we saw the immediacy of that damage. Well, now the Fed's balance sheet is more than 2 times as big, and the leverage by definition would have to be that much bigger too. And how does it happen? We'll see. And where are you're always going to find them. You're always, as I discussed with Barbara Kaum from the Central Bank of Austria.
That was great.
It always comes from debt. And I've talked about that with many others. Debt is going to be the issue. And there is my last blog I did on Sunday, and I said Volcker couldn't be Volcker because of this, because of the amount of debt that is on the books today. And I give you a really good comparison of public and private from 1980. Had Volcker gone that route and crushed inflation like that, he would have brought the entire system down. But there was so much less debt. So who paid for it? We had a severe recession, really paid for by the workers of this country, farmers and everybody else in the private sector, because business slowed down so dramatically. This is a whole different world that we're in now. Oh, again, only because the amount of debt. And if you don't think so, go look at, you can go find, Google it and find out global debt and look at it from 1970 to 2000 to 2022, and you'll see an interesting picture, and it makes it so much more difficult. So it's not an easy thing to answer, and again, they don't know. I'd like to see them do a trillion of debt shrinkage in the next 6 months, because that's kind of what's the name's been out there yelling about, Ackman and others. But let's go and find out. Let's do it already. But I wouldn't be raising rates again. He made that mistake in 2018, and he had to walk back from it quite quickly, as we know. So definitely should have learned some lessons. But again, let's see. We're very early into this. But when I look at the minutes today, I'm going to be looking at what they just had to say about quantitative tightening. But it's a good question, Mark.
Yeah, so just a quick follow-up.
Yep.
I guess in 14, they got it down to 4.5 trillion or so. What's their target? What's their target for now? And kind of what is that?
Not 14, 18.
18. Yeah.
18. Okay.
Yeah, no. They started at 3.9. So what did they get it down to? I don't think they got it under 3 trillion. And now, of course, we're up to almost 9.
So
they're not giving us a target.
Yeah.
They don't. The target would mean how much they think would be a healthy amount of reserves to sustain in the system. And they're very reticent to say that. So we don't know. But if there's one guy, Raphael Bostic, he was the first person who said it probably back in November or December, that he thought they should go to 100 billion right away. I thought that was right, but I wouldn't have been raising rates then. Because if you're going to go radical, and that's radical only because you don't know, you have no way of knowing what the impact is going to be. So why would you go both? They do that because they're trying to maintain confidence in all the players.
Hey, Ira.
Yeah.
Jake here. I've got a thought along the lines of, the debt comparison to the 70s and 80s compared to now and the leverage. And tell me if I'm on the right track here or whatever, but like you take the debt, and I don't have any specific numbers, but like say you double the debt, you're not just doubling the leverage, you're 5 times, 10 times, quadruple in the leverage, right? I mean, is that
It's, yeah, it's huge, because when we talk about it, we talk about loans all over the world, right? And loans are,
on fractional banking?
yeah, we're talking the actual banking, but we're also talking other elements too, you know, the huge amount of sovereign wealth funds playing, hedge funds. There's a whole lot of leverage in the system. Real estate is a huge leveraging. You know, let's say you put 10% down, right?
Yeah.
Now all of a sudden you have an asset that might start declining. And if you have, you know, a lot of places only issue some type of floating instrument, now your rates are going up. And if you borrowed in dollars, because hey, dollars were a cheap way to borrow. Remember, we have an example, by the way, of what happened in Eastern Europe in 2015, of January 2015, when all the Eastern European, or many Eastern European countries and banks were issuing mortgages in Swiss francs. And that was, you know, because the Swiss interest rates were very, very low. The Swiss had pegged their currency, so you knew kind of where you were at. And then when they broke the peg, the pain and suffering was enormous. And this, you know, the Swiss franc appreciated quite a bit. The interest rates didn't affect you, but the appreciated Swiss. And again, because they thought that the currency was pegged, you know, there was no need to hedge, right?
Yeah, and they, like you said before too, they spend too much time stepping over dollars to pick up pennies when it comes to hedging, because they don't see the full impact that could have by hedging it. They just don't want to spend the few cents a month to do that.
Yeah, and going back, because don't forget, a lot of these people were in euros, and they exchange your euros to borrow Swiss. So when you borrow in a currency, you're basically short that currency. You know, that's how you have to look at it, because you got to pay it back. So when they did that, they said, well, you know, they believe, and the Swiss National Bank, up until about a week or two before, came out and said that they were going to hold that peg, and they were standing fast at 120. And I was on Santelli twice, once in December, once January. I said, I can see the way this is trading on a chart, that you can't get up off that floor. There's no way they can keep sustaining this. And a week later, they let it go. And you know what? The lawsuits again are still going on for people who felt that they were terribly misled by their banks. Because even today, the Swiss franc is at 105. So you're still, you know, bleeding pretty good from an exchange rate you thought was fixed at 1.20. So yeah, you really have to be careful with this. And that's where the leverage really exists in the entire global system. You have emerging markets, corporations borrowed in dollars, and people borrowed dollars because they were cheap. You know, we sat at 25 basis points for quite a while, and the Fed was pumping nothing but money in the system. So again, now the dollar is appreciated quite a bit. This is a very, I think, very dangerous point for them.
And that's a bigger deal than the interest rate altogether when you start talking worldwide stuff, right?
Yeah. Oh, yeah. And people don't seem to be paying attention to it. I keep having discussions with some people. I'm waiting to do another Zoltan, and we've been emailing, so I know we're going to talk about the dollar, because it was one thing missing from his last piece.
That'd be great.
And I asked him about it, so hopefully we will get to that. But these are not unimportant things, and I really think that, see, everybody talks about the dollar only in a trade role, right? Oh, they want weaker dollars because they get an advantage. That's not what we're talking about here. We're talking about the dollar as a funding vehicle and people who are borrowed in it, which makes them short.
Let me ask you, how high would the emerging markets need to have the long bond in order to offset the pain that they're suffering from the strength of the dollar?
I'm not sure.
Is that even
I'm not sure what you're, where are we going here?
I don't know. I'm just trying to think of some hidden agenda by either the Treasury or the Fed that thinks that they can stave off a worldwide deep recession that could border on depression.
Oh, yeah, well, the only way we can compare that, and I think that this is very much like the 70s, because in the 70s, we had soaring grain prices, soaring energy prices, and what we called then third world countries, not emerging market country. Hold on one second.
And at the same time we had that going on, we had more of a fiat currency created all by taking stuff off of a little bit, taking it off the metal standards to a degree.
Well, yeah, but here's what I would, and I know you have to be careful with this, by the way, because it's never easy to, but if you go back to the 70s, the problem was that all these countries, everybody thinks that the emerging world does so well when commodity prices rise. Not all of them are exporters. A lot of them are importers of many goods. And they were borrowing in an effort merely to sustain imports. And the big banks who were laden with cash from the OPEC countries, don't forget Citi, Chase, they were all rushing over to the Mideast once oil prices started to rise. And these, the OPEC players were sitting on just bundles and oodles of cash. I hate that word. But that's what they were doing. So are we going through this again? Are we going to go through this again? Well, there's a lot of people out there warning right now about massive starvation coming because grain prices are so high. So I said to somebody, I said, if I ran the IMF, because I've done a little research in this, anybody who knows more certainly pipe up, that rice is a very good substitute. And economics is so much about substitutes and complements, but rice is a very good substitute. Well, if I was the IMF or World Bank, I'd be buying all the rice in the world I could right now and paying everybody in SDRs.
Oh.
But, I'm just amazed that they don't, because rice is on a relative basis. I mean, you can put up a wheat rice chart, but divide by, and you see that rice is really a fairly much cheaper grain because it's been fairly plentiful. But if you get a bad crop in the US this year, don't forget we're at these prices and we've run record crops year after year. This year you had a little bit of drought in South America and the crops never filled out like they were expected to.
Yeah, and it's a logistical thing too with everything in the Ukraine and wondering where that's going to go and how it's going to get out of there. And so there's a lot going on in the grain world. But and I don't know. You tell me what you think. But like sometimes
I'm coming. Wait, hold on one second, Jay. I'll be right.
Yeah, no worries.
I wonder what if we start paying for things in the SDR, I wonder what that means for the long-term viability of the US dollar.
I don't know. I know on like the raw commodity side, and that's what I was going to get into a little bit, if that's okay. But like they say, the price of corn can double and it doesn't affect the box of cornflakes more than like 10 cents, because there's so much in there that's everything else versus a raw commodity. But I don't know the total specifics on that, but it's they're high right now, but the cost of production is high too, just like everything, just like crude, just like
NASDAQ failed to get up to well, it got up to 930, so that's good enough for now. 940, 950. I lowered the 970 target. NASDAQ is still lagging. Boy, I'll tell you, the NASDAQ is weak compared to the S&P. That's a decent high in the S&P. Overran it a little bit. We get above this 3972, 74 area, then we'll see 4005, but it's going to be a difficult fight to get up there. It'll be different. It'll be a difficult trade to get up to 4005, but if they get up there.
Is it raining all week in Chicago this week, PAX?
Yeah, it's supposed to be now. It's gonna get good on Friday when I'm in bed. Saturday, Sunday, Monday, Tuesday, Wednesday, all sunny and warm. So a lot of days to golf there, and I'll be
There you
laying there chilling.
Well, it'll be better on the other side of it, I'm sure. So
Yeah, no doubt. I'll be able to see the ball without having to close one eye.
yeah, absolutely.
Seriously.
No, that'll be great.
So be able to have a, might be able to have a drink without having to worry about the ramifications that steroids or any of the other medicines have taken.
Yeah, it'll definitely be worth giving up a few days of golf for.
Oh, can't work out, can't do anything, but can't lift anything more than a gallon of milk.
Still do 12-ounce curls then, right?
No, I don't really have, because I'm always kind of fighting nauseousness. I don't have, I really don't have much of a desire to drink ever.
I don't either. I'm just giving you a little grief. I can't hack it anymore. Well, I can hack it. I can't hack the next day or don't want to hack the next day. So I just don't do it.
Because you're getting older.
Yeah. That is correct. It's inevitable.
Okay, I'm back. Sorry. The landscaper was here. I had to take care of.
Straighten them out.
No, he's got a leak in a pipe somewhere. All right. So where do we leave off? I'm sorry.
I was just digging into the grains a little bit that, even with the higher commodity prices, the actual cost of food, it's not really increasing the cost of food as much as people really think. I was saying at PAX too, like you take a box of cornflakes, you can double the price of corn, but it's not going to add 10 or 20 cents to a box of cornflakes. So it's some headline stuff too, to a degree.
Yeah.
Not that way, but some of it is.
Jake, that's right. Except the cost of diesel, the cost of fertilizer. So it's,
The production costs are going to be, well, they're high right now. They're going to be higher next year. You can't even get a price on certain fertilizers right now for the next growing season.
Right. Right. I mean, so and again, the transporting of it, if you can find it, and I stress yet again that I would say definitively that when we saw prices go up after the great sell-off of 2020 in the panic and the deleveraging of the global system, you saw grain prices come right back. And I had surmised that was because as I watched the Chinese currency appreciate, that the Chinese were certainly stockpiling, and they were, and I got into arguments with some people, and it's not arguments. Arguments is negative. I got in deep discussions about now. I said, well, how do you explain grain prices going up and they're going up as the Chinese currency is going up, and everybody thought that the Chinese currency would go down because they would seek to protect their export markets, right? So you weaken your currency. It's been the Chinese playbook, the Japanese, a lot of people's playbook over the years, especially if they're just a really developing country. So,
and even you and Zoltan touched on that in that podcast you guys were on the commodities to dollars,
right,
stuff like that.
No, very important, and this dollar issue, and that's why. And everybody says, well, it's a domestic United States. But the United States blew up the world, meaning exploded leverage through its policy, because as the dollar, as the reserve currency of the world, there's nothing you can do to prevent it, right?
No. Well, and maybe and I hope I'm not going off the rails here or off the subject, but you take and I don't know if a lot of people realize this, but we had such a car market in the last year or two where people couldn't get cars and vehicles, and there was huge demand out there. Well, that's starting to affect a lot of other manufacturers are doing the same thing. Like they're only building stuff to order, and they're not going out there and overproducing things. And, whether it's ag equipment or, home decor stuff, whatever it might be. And I always sit here and I think, well, you can raise this interest and everything else as high as you want, but you're not going to unbottleneck that by doing that. You're not going to promote any more overproduction of anything to bring the actual supply up to bring the demand a little bit lower on,
Right.
you know, on everything.
Yeah, they think that this is an easy, there is no easier, but at least Powell was honest enough at the last press conference to admit there's nothing they can do about supply. So all they can do is crush demand. That's all they can do.
But the trouble is, if they can't crush the demand of the
Jake,
things that people have to have, like and I'm not trying to argue, but I mean, I'm just saying there's certain things, it's not a choice whether people buy them or not. If they need certain things to live or produce certain things, you can't crush that demand. Can you?
Well,
well,
you can especially curtail the use of services, right? Because especially when you look at the wealth breakdown. So if I take the top 30% of the country and their house prices start going down a bit, their stock portfolios start going down a bit, some people are losing their jobs, you are going to affect demand. And that's what they're going after.
Yes.
And you know, somebody, when I wrote that blog piece about it, I wasn't saying class warfare. Somebody said, well, and no, it's not. I said, well, you know, some people view it that we've been in class warfare since the early 90s with globalization. So I'd be careful, you know, just throwing that around. But number two, I think there's many people in this White House who would love to see nothing more than the wealth gap diminish from the outrageous levels that it's at. And I'm not necessarily not in that camp. That's a big way to say it, and there's a lot of ways to do it. And as Biden himself said, well, you know, we could just raise taxes and slow down. Yeah, if you were to really raise taxes on those who would really do that without having to do wealth destruction, you could probably do that. Would you have as much effect? I don't know. But everybody's running around with their models out there trying to figure this out. And you know, but if you really want, and Powell said it, they're going after the demand side because there's nothing they can do on the supply side. You can't all of a sudden, you can't 3D image more grain to eat.
Right.
You know, I know that.
More fuel.
Yeah, the technology is powerful, but you can't. These are things that are a process. And by the way, they've done nothing to aid and abet the process. Okay, so let's be honest about that. It's not like, you know, hell, there's no Keystone Pipeline. And I mean, that's the low hanging fruit. You know, anybody can go after that as far as.
But they're not making it easy for any oil producers to produce more, you know, I mean, all of it. So it's, they're not helping that situation. In a nutshell.
Well, and especially with the ESG movement, and I'm not a fan of it.
Me neither.
It's just too broad a brush to paint with. And then you wind up with all these goofy situations. And that's what you've had. So a lot of investors who would be rushing into the energy sector yet again are staying away going, well, I'm not making any long-term investment here because I don't know when the rules are going to change again.
Because we don't trust the government to keep that industry going, you know, and
Yeah,
that's the same reason the industry doesn't, you know, isn't investing in itself because they can put a lot of investment in it and the next day be out of business.
Yeah, that's right. So who wants to put, in fact, I'm having one of my, used to be a weekly meeting, but we're meeting tomorrow. It's probably the third of the year. And we're going to discuss this because we waited for a guy who's a wildcatter.
I was wondering that.
Huh?
Your buddy from Kansas.
Yeah, he's home in Kansas, but he's actually coming back because he has to go to the doctor. So
that'd be interesting.
We arranged this in a very short fashion, but him and I have been going back and forth. I love listening to him because he's been telling me, he says, nobody's putting any money to invest. You know, you do what you have to do on a day-to-day basis, but until you get a commitment from the government, they're not willing to commit.
Yeah, they got to run lean and mean to survive.
Yeah, exactly. Because now they say, I'm just going to try to take out as much money as I can, as fast as I can, if prices stay high, fine. But why am I going to commit to a long-term strategy when they're not going to support a long-term strategy?
Yeah, yeah. Who wants to put their head on the chopping block for
Yeah, they're
for
just
that?
looking, they're just looking for, again, and this is something we've been discussing here since November. I know that every time I've been in here, this White House, every White House, every politician is always about the optics. They want that photo op. It's what the G.
Yep.
But this administration, by their own, by even people on who are liberals, attack them because everything is optics. So the optics are you have to head off headline inflation because, again, their political analysts told them after the very tepid Democratic election results in November that that it was inflation. And the latest data I've seen is people are, I think it's almost 4 to 1 that they poll worried about inflation versus COVID. So inflation is certainly at the top, but it's all headline inflation because if they could get the headline perception, which is what they're gearing for. So, but when Biden says, I'm all for the Fed, I respect Fed independence. Yeah, job one is to get rid of inflation. Headline inflation. They need to get headline inflation, and they've realized that nothing has worked because, of course, their first measure back in November was to release oil from
The reserve.
from the reserve, and now they're still doing it.
Yeah.
And now you can always apply the what I call the Leisman rule of counterfactuals and say, well, imagine if we hadn't done it. That's the fallback again. But when you're the king and you make the rules, you can deal with that. But they're concerned about these optics of the headline. And I'm going to tell you what, I will be shocked if we got a rate rise after September. To tell you, see, that's why I'd be going gangbusters on shrinking the balance sheet, because that's not a headline grabber. Once you do it, it's just a process. And even if I increase it and say, well, listen, I have flexibility, I can do it. So even if I want to increase it, because I'm making the rules up as I go anyway, but it's not like Fed raises rates 0.5%. I would absolutely, because I think the impact from shrinking the balance sheet in an overly leveraged system is much more effective.
Yeah, and it won't get noticed as much.
Yeah, I would.
Yeah.
Listen, the way the media is so lazy, won't get noticed at all. I got news for you.
Yeah, for sure.
And the media really disappoints me because they just every time they ask that question, every time they say thank you for taking my question, I can't stand that. That's your job to ask it, and they've invited you there because that's the way the game is played. You don't have to thank me. Just ask the goddamn question and actually put some teeth into the question. That would be even better.
Yeah, absolutely.
So, I mean, these are not, we are, and you've seen the market reactions. Look at today's action. You get giant ranges. It is not that they may, I think their ability, I know people like to count up how much global, how much destruction, wealth destruction there's been, but I think you're seeing it. And I think, look at the housing number yesterday.
Yep. I think Phil was going to say something about the housing, but I didn't quite catch it. But I hope I'm not beating a dead horse with some of these questions here. But
No, because again, we're looking at this not through investing lenses, through trading lenses, and this is shifting all the time. But I thought yesterday fell off of the dollar, and the dollar was weak yesterday. It's actually been weak since Yellen made some comments at the G7, which is good because she must have gotten an earful that they really don't want the, people are waking up to this is a different effect from before. They really don't want the dollar too strong because of all the debt. And yes, the Fed has a standing repo facility that's open to foreigners, but I think the amount of debts that we're talking about between all the central bank action all over the world, and the amount of leverage in the system is so great, they really have to be careful, because once it starts turning in on itself, it almost becomes like the, and I'm not pretending to be an astronomer, but the effects of a black hole, right? That just suck everything in. As
The leverage works really good until it doesn't.
yeah, as everybody runs to raise capital because they're worried about all the shortfalls that they're going to have to face. So, these are what makes these times so demanding. And I'll tell you what, every time I think I'm patient, I'm not patient enough. And I'm not good in these rapidly declining markets, because if I have an idea and I see some early value, and I stress early, it's not a good thing. So I've had to, again, I'm busy relearning my lessons. I'm seeing this very well. Trading it is always far more difficult than I ever believed.
Isn't that crazy? I've had a great year trading it from January, February, March. And then since like a week before the last Fed meeting, I found these markets to be incredibly difficult trading.
Yeah, I gave back a lot of my year, and I was trading really well. And the frustrating thing is, it's like people will call me and go, "Wow, your blog's right on." I said, "Yeah. I don't want to hear about it." It's easier analyzing and seeing it than because you think, "Wow, this is really providing me a good value. I've been waiting for this value," and these algorithms can just destroy you faster than you can even imagine.
Oh, and that's the exact point. Isn't that crazy? Every trader I've spoken to has said the same thing. They've given back their year. They've given back significant chunks of it, and which always brings me back to two things that Judd would drill into my head from the late 90s. Get out when you can, not when you have to, and trade to make money, not to be right.
And here's the flip side. It's in the FT today. Quant hedge funds reap windfall during 2022. Quant hedge funds, they've had terrible years while we were having good years, but a lot of money in this because it's just all numerical. They're not looking for fundamentals and value issues that we may be dealing with. They're just powering. And this is a market where if you power and go with it, you're doing great.
It's hard to do. The algorithms are trading for clicks now.
I've never been good at it. Had I been good at it, I'd be on TV more.
That's funny.
Hey, Ira,
yeah.
you had mentioned on here, I would probably say maybe going back to last summer, maybe fall, we talked about real interest rates and we talked about housing, right? And I guess part of that is the data that, why I bring this up is because the data that came out this week was so poor and how it missed. But there's a lot of comparisons to 08 in the housing market, but there was a lot more systemic risk then versus what we could suspect now. So with that, you had made a comment one time about, I'm just going to try to paraphrase here, that the Fed or maybe the government wants housing prices to move higher because they can inflate debt away and having more equity in the housing market. And I just thought that was pretty interesting because a lot of people, if cash out refis right now, or the demand is still really strong. So I guess the consumer is still okay if they're able to get all that equity out of their homes versus where they were trapped in, say, 06 to 08. Bit different of a scenario this time around.
Yeah, that's a very good point. And what I always say is, the rule of thumb throughout history is that the way to get rid of debt, of course, is to inflate it away, all debt.
Yep.
And some people don't believe that, but I think that that's really the history of the world. And again, the book pretty clamored about it, and I think in 2010 or 11 was when Rogoff and Reinhardt came out with the book. This time is this time is different. Yeah, this time is different. And it was a prescription of how to deal with the debt overhang. And Rogoff talked about basically trying to have a contained inflation of 4 to 6% for a few years in order to alleviate some of the pain of inflation. Now, somebody will get stuck at the end of this. And it might be going on now, which is why the housing market can turn down faster, because all of a sudden everybody was plucking down all this money. Yes, you have a low mortgage rate, but you paid exorbitant amounts of money to get a house. You know, I can speak from personal experience where I live. When I bought my house, I think I paid $280, $290 a square foot. And that's how I buy houses, by the way, or I try to sell them. I didn't do a good job of selling my house in Chicago. I did a terrible job, but that's because you get involved in family, and that's never a good reason for doing anything. But we're here, I was paying $280, $290. People are rushing in. They're coming from California. They're buying homes sight unseen and paying $700 a square foot. Now, that's well and good while the money is cheap. But once the money, now all of a sudden, when that price drops, and it will, to 400, 380, 350, there are a lot of people who paid up for a lot of money who are not going to feel very wealthy. You know, and so much of it is just what we refer to as monetary illusion. When you feel wealthy, you spend more money, which is how Powell is going to try to affect demand. He doesn't want you to feel wealthy because he's trying to curb demand. Exactly what they're trying to, as Zoltan was so beautifully in explaining this, exactly what they did with QE and Ben Bernanke's portfolio balance channel, which was to get you to feel wealthier in order to unleash, quote unquote, what Keynes would call your animal spirits. They're now trying to do the opposite. This is a very tough needle to thread. Now, I wish him well. I just don't see it because they took this to such an absurd level. That's the real issue. QE should have ended 18 months ago. Or if you didn't want to end it, at least put it on hold as you were starting to see the rollback of the crisis. Why would you keep going knowing that you were going to run into this situation? Yeah, that's what bothers my mind every day. I think about Jerome Powell. What was it? Why couldn't you prevent yourself from going to such an extreme?
Well, I would guess the largest banks and the biggest funds in the world weren't ready yet.
That's it.
Well, no, but he was always saying that, you know what, the banks are healthy, right? We'd hear that over and over again. He's still saying it. You know, we don't believe that financial conditions, and now that's, of course, new operative phrase. That's what you're washing, financial conditions as a way to stem demand. Because if you can tighten financial conditions enough, you will harm people's feeling of wealth and get them to curtail their spending. But he would tell you, oh, the banks are flush, da, da, da. Well, I have a question to ask. If the banks are so healthy and everything, and I'm not saying they're not, but when I look at JP Morgan down, 25% for the year, now maybe, 20%, why? Why? What's going on? What am I missing here? That's their fallback position. So when you say that, that's exactly you. And I'm not saying it's wrong. They may be absolutely right. And from all their metrics, they're right. But something just does not seem right. Let's put up, you got any charts up there, Senor? Can you put it
Yeah,
up?
what are you looking at?
How about XLF? What does that look like? I hate ETFs, but I'll look at it.
Ripping actually right now.
Yeah,
34.11. It's the 34.11. $34.
but look at what is it for the year? It's probably down.
Oh, down 30%.
Yeah, not quite 30. It's down $5 for the year, right? So it's not nothing. But I'll give you a better one. And I know we can always find. That's the problem with charts. You can always find something. But today it's trying to save itself. HYG, which is the high yield ETF.
I noticed that junk's ripping. Yeah.
Today, it knows it's in a very, it was in a very critical, so it's down $9 on the year, a little bit more. But if you put up a monthly chart of HYG, can you do that, Matt?
HYG
HYG.
down to 77.81.
Yeah, but look, it's been down this week. It's been down to 76 and change. So, but when you look at that and you go back to see where this is, okay, and if you go back to 08, the low month.
That's what goes, but you're gonna say that what's what goes first, Ira?
Yeah, it's an interesting looking chart. So I thought if you closed under $76 for the month of May, that was not going to be a good thing, right? Here, and then if you want to bring it closer on board, March of 2020, which we all know what that was,
Yeah, that's amazing.
it closed at 77.07. But look at what a wild month that. You want to see how wild that month was?
Down to 67.52 and then right back up.
Yeah, so 77.07 this morning, and the last few days I've been watching it. Let's see if, and it's just something to watch because it'll show you that there's a little bit more stress. But if it's all as healthy as some people think, there are certain things that just are not acting well. Now that can just be pure losses being taken. I happen to agree with you, Mark. They are getting exactly what they want.
April in 18, HLF didn't have much of a response going into the end of 18.
Wait, say that again.
Going into the end of 18, I mean, going into the end of 18, I think that's interesting. The Powell pivot, the HLF did not have much of a response. It was lower, but it wasn't getting killed. Not like in 21, not like in 20, and not like back in 08.
Okay.
So I'm wondering if that's.
Well, it's just, I think these are very important things to look at. That's the only reason I bring them up. I think they're very important to look at because we have to put these things in context. Otherwise, they're just words. Yeah. Oh, yeah. And then it's a headline and you're running with the headlines. But what's the contextual basis of it? So this is what I'm busy watching. I think these are really important. So, I just go back to, I think, Mark's question about, well, the banks are flush. We hope so. Yes. Are they as badly lent as they were in 06, 07, 08? No, not a chance. But you have some stress in auto loans because you have a huge amount of subprime loans as the cost of taking an auto loan out is soared. So and now you're talking about writing down all that student debt. There are issues in the system that need to be watched, but there are enough things here. But let's go back when Mark says they're getting exactly what they want. That's right, because Powell told you there's nothing else they can do. You can't affect supply. Well, if you can't affect supply and you're trying to head off inflation or inflation expectations, to use the Fed's words, you have to crush demand. You have to crush it. And they really run into a problem here because they don't think so yet. But the inflation problem is why they're struggling is that even while people's paychecks have grown throughout the last 18 months, the cost of living has risen. And so real wages are probably about neutral. People are not getting the huge, and I'm being kind with that. I don't want to go too far astray because then you're just political muckraking as far as I'm concerned. We are much more concerned about other things as far that we have to worry about. So that's what I'm looking at. But they are getting what they want, and come to believe it. And there are many people in the White House who would love to see the top 10% in this country take a huge hit. They think it plays well to their base, and everything they're doing is trying to get their base out. So,
what about the S&P bond spread? How are you?
Oh, it's so wild. It's been such a great thing because it catches so much on a day-to-day basis. But we're under the 200-day again.
Yep.
every time it rallies, like early this week, I think the chart is to me heavy looking. Yeah, look at the rallies that we've had up to 28.70. So, but these are charts I show people, and I said you can make fun of them all you want, you could belittle them all you want, but they do a lot of the heavy lifting if you pay attention to them. And right now, it's not really looking that good. And as other people have talked about it, Louis Gavay, I've been so fortunate to be able to do these podcasts with such high-level people. It's unbelievable. That Zoltan piece, I think it's up to 85,000 watches, which is unbelievable. Because most of the things I do get around 1,200, 1,300, unless with Mark Faber, Moore, Zula, if they're names that people know, they'll find their way there. They're not coming for Ira Harris. Trust me. Zoltan is as hot as can be right now because you either love them and love reading them. Not that you have to agree with them, but there are a lot of people on Wall Street who are very envious of them. And I've talked about this personally because I said I could see it. They don't want to. They can't attack you on the merits of what you're saying. They're just kind of nibbling at your newfound popularity. Because I'll tell you what, for years I read them, and nobody. If you talk to people about Zoltan Bozar, their eyes would gloss over. But he wrote those 3 or 4 pieces in February. First one prior to the invasion, when he wrote about Powell finding his inner Volcker, which picked up a lot. And then he wrote those pieces about the replacing the petrodollar, as he called it, and the other piece, which got a lot of media attention. Therefore, he got a lot of attention. And I think Zoltan has always been a relevant and worthwhile read. He's never been as global macro. I found my way to global macro because of the way that I look at interest rate structures. So that was a really good opening for me. But that's now people are say they read him. He's still not easy. And he's one of the best plumbers in the world. When I say plumbers, one who really understands the ins and outs of how the overnight and short-term interest rate market works. That's why I started reading him. He's so good. But these are wicked and wild times, so to speak. And they're going to be with us for a while, especially if the Fed is serious. And as Jimmy Bianco, who I love, said, they will go until they break something.
Right.
You and I have to find what's going to break.
Right. And the S&P bond spread looks like it could be equities.
Well, there's so much, the housing, now, and then we get into Lacey Hunt and David Rosenberg.
That's right.
So we are at a huge precipice.
For my family, it'll be good. We've stayed in cash. I didn't go buy a house in 18, 19, 20, or 21. I thought it was overvalued in 18. So, I missed it. Hopefully we get back down to that. And at least from my standpoint, sitting on some cash and give me a chance to deploy it in other investments as well. But what's going to get broken and how much pain will it cause?
Yeah. Well, that's always the case. But it's going to be difficult for the Fed too, because when people really begin to understand that they're intentionally going to break something.
Hey, Ira, this is Phil. How are you?
I'm good.
I haven't talked to you for a while. Sorry, my voice a little bit of a cold, but you and Jake we're talking about Fed policy and whatnot. And a lot of what we were talking about, I just kept thinking some of that interlaps with congressional policy, because Fed policy is just, typically controlling monetary flow and monetary policy, but it's Congress's job to put in position of structure and foundation to grow an economy. So, the Fed can raise rates, and a byproduct of that might be tearing down wealth on paper, and people might not feel as wealthy, therefore might not go spend, and therefore it might bring down demand. But, I guess, where does the Fed stop and Congress begin?
Well, don't forget it was Larry Summers who warned them about fueling too much demand, right? Summers was all over. And then, you know, somebody who's disappeared. That's why I truly, the media just irritates me because, again, they take sides, and good journalists, you know, I shouldn't even know what your views are, but of course, that's all we do is know what the media's views are. But Manchin should be celebrated because just imagine we had another 1.9 trillion coming down, and he got beat up. But I followed Manchin's comments pretty well because I actually agreed with him. And here was somebody who read what was in the bill. You know, I argue with people. I said, you've never even read what's in there. I said, everybody's going to cherry pick out what they want. Oh, well, this is in there. Well, yeah, it's like every spending bill in the history of the United States. But Manchin told them, look at, and this is what caught my ear because I'm a big believer in early childhood education. And I think it would help, especially the poorer elements and those at the lower end of the income scale, to have much better support from 3 to 8-year-olds. I mean, the Black Panthers, when I was young and active, were highly endorsing that with what was known as Operation Breadbasket. And they were busy, oh no, I'm sorry, Head Start. It was all under the Head Start program. And I was a big believer in that. The problem is that the Panthers wanted to run the programs rather than the city machines. Believe me, I was in Chicago. I was really at 15 and 16 getting very politically involved. It's just the way I was, and I was paying attention to it. And I believe in it. So when Manchin came out and said that and said, look it, I'm all in favor of that. Let's negotiate. Let's take that out and vote on that separate from the rest of the bill. And he took a beating and they said no, because they were a bunch of petulant children. We want all or nothing. So they got nothing. And actually, it's a good thing that they got nothing, because had you thrown all that fuel on top of this, who knows where we would be and what we would have to embark upon to end it. Right now, you know, government spending for 2022 is going to be way down. So, you know, that's where some of the more people who are going, you know, you're overblowing the inflation. First of all, as Lacey Hunt talks about, money growth is slowing dramatically and velocity, and you have less government. So don't get, you know, and that's what some people are warning about. And that's why they say the bond market has been reacting so strong regardless. We don't know yet. That's a long conversation. But will the government pick up for it? Not at this point. Not as long as you have massive inflation, you know, or you have inflation running much hotter than everybody wants. So you're going to have to be careful. But you're right. If they do break it, they will step in somewhere. We know that. It's just way too early, because even the White House keeps applauding everything the Fed is doing and keeps imploring them to do more, because they need to break the back of headline inflation. I think you won't see anything for quite a while.
Yeah, was almost thinking the same thing. I was thinking that they probably they wouldn't do too much on hikes after, you know, as we get closer to the election time.
Right. Oh yeah, they're not. Yeah, you know what? And for all, I think Volcker. Well, if you're finding, I think Volcker was one of the few who had the strength to do it. But most of the time, they don't. You might see a rate cut, but you very rarely see rate increases going into an election. Although, wasn't true in George Bush's second election year, George the First, and it was why Alan Greenspan was not reappointed by George Bush II, by the way, because the Bush family was furious with Greenspan. They felt he should have cut rates to get the economy going into the 92 election. And not only that, when Bernanke was not the choice to replace Greenspan. It was Don Cohn, who I think is really a very good central banker, having read so much of what he's written. But he was the Fed vice chair, and there was no way they were going to let Greenspan be involved in selecting the next chairman.
I heard. I'm sorry, Matt.
No,
Yeah,
go ahead.
I'm done.
Oh, Oh, no, no. I was just gonna say, we got Fed minutes today, and typically doesn't mean much. However, the last day Fed minutes came out, I think was the 5th or 6th of May, and sparked a huge rally. Do you see? Do you have any thought about that?
Yeah, right, and it could happen. But again, when people ask me what I thought about the last Fed statement, I said I was only looking at the quantitative tightening part. Whether they were going to raise, the fact they raised 0.5%, we already knew that. And I think they were going to raise 3/4. No, I didn't think they had it in it. But I really thought that they would go to full blown, after what Bostic had talked about, 95 billion right away, and they would start immediately. And when they came up with 47.5 and not starting until June 1st, I got a little, I thought that was on the soft side of it. And when I heard Powell talk, there wasn't anything that really had shown me much. So I'm interested to see if they put in what the discussion was about quantitative tightening. That's what I'm interested in. The raise of rates, to me, again, until we get to some level of zero real rates, it's all, to me, a lot of gobbledygook. But I think the ability for quantitative tightening to really shake the global financial situation is very real. So
is it your opinion that the market's priced in, 4 or 5 hikes?
Yeah, that's my opinion on that. Well, it's not my opinion. I can tell you right now. Here, so we're at 75 to 1, right? Yeah. So yeah, because I can look at the December Fed funds futures contract, right? And it's up a little today. It was up yesterday, so it's at 97.45. So by December, they're basically pricing in 2.5%. It's not, that's what they're doing. So the market, I'm not doing that. They've done it. I'm only reading what whatever indicators I have are telling me.
Interesting. Thank you.
Yeah. Again, if you look around, there are enough barometers and things I don't have to, I'm not guessing on that. The market has done that for me already. Now, can I be stupid and disagree with it the whole way? I could, but it's not a good way to make a living. So,
for sure.
And if nobody's got anything else, I'm going to go put the peg in the ground and whack.
I ain't even going to ask what the hell that means.
Play golf. Play golf. Play golf.
Ah, there you go.
Put the peg in the ground and wax them.
I wish I had. I wanted to go play today or tomorrow before I have my surgery, but it's raining.
It's raining?
Yeah, and it's cold again. It's back in the 60s.
That's when I like to go out to play, when nobody's there. See, now it'll be 100 here, so it'll be, the course empties, and a lot of people have already deserted the desert, all pun intended, in order to, because it's hot.
You coming out to Chicago anytime soon?
No, not planning. I'm going east to see kids and grandkids who I haven't seen in quite a while. Although Alex was here in April, so I did see her. But I'm going to go to New York and Maryland for 16 days, and then the real heat comes in July here, when you walk by noon, it'll be 115 for sure. You know what? Actually, I'll go out and play golf then, because I'll put on a hat and I can play in 2 hours.
Yeah, I don't mind that heat either.
No, the sun is just so hot. That's what really that's what I've had to get used to, is how much hotter the sun is.
What about when they talk about dry heat versus the humidity heat?
You know what? The danger of the dry heat, and it's dangerous, is when I'm in Chicago and I grew up on the playgrounds playing ball, all I was outside. So you're sweating like a pig. By the time you get here, you don't sweat like that, but you're losing moisture. That's the danger of being in the desert, where you would know, being on the playground, the asphalt or whatever you're playing on, it's 90 degrees and the humidity is 100. You're sweating so profusely. You are drinking so much water because you're so aware how much you're losing. Here, it kind of creeps up on you. You really have to pay attention.
Remember how good the water tasted in those concrete
Oh God, yes.
water fountains that the Park District had?
Yeah, and then you know what? The neighborhood bullies would always screw them up in the summer because they'd be hanging out with nothing to do.
That's a good point. I forgot about that.
Yeah, so you know what? Yeah, and you go, "Ooh, why would you do that?" You know, they put gum on, yeah, you know, all kinds of shit.
One of those things. Well, thanks for coming in and spending time with us again this morning. I'm
Yeah,
sorry.
yeah, no, I'm around, you know, and everybody says, "What do you?" I said, "I'm working. What do you think I'm doing?" These markets there's so much going on and there's so much to pay attention to. There really is. I mean, I have not seen stuff like this in a long, long time.
It's funny. I've been saying the same thing. I've been saying the same thing.
But it provides opportunity, but I can't explain enough how much risk there is in these markets and how you just have to keep being patient. And if somebody wants to go do, you know, again, the grain prices are sustaining themselves. And I worry about a real food crisis. So something to pay attention to. And if food prices stay high when everything else comes off, we're going to be in another bad situation like we were when China was the one, you know, busy aggregating, you know, huge supplies. That's really all I got. And pay attention to the minutes, but the rates we know about, you know, and everybody, you know, the media will try to, some people said 1 3/4, you know, Powell's in charge and he's asserted several times a half. And let me bring one more thing up to you. You have new voters now at the Fed.
Yeah, great point. Yes, shit, I got to write that down. I thought about that the other day and I didn't make note of it.
And these are not, I don't care what anybody, I will go back to what's his name talked about, Furman from Harvard, who called this when they were appointed. Let's see who's on there. So we have Philip Jefferson, he's a new, and Lisa Cook. We know Lael Brainerd. So we have some new dovish voices, by the way. So that'll make coming meetings interesting. I wonder whether anybody will ask a question. Probably not. So and they are very dovish, by the way. Lisa Cook especially. I went and looked at her research, so I know that. Oh, Jason Furman is the one I'm thinking about. He called this the most dovish announced appointment when they were appointed. You can go read the article, in decades. So that's where it lies and that's where we stand. So good luck to everybody.
Yes, thank you. Good luck to you.
And just send me a note when you want me again.
I will. Maybe next week after my eye starts, you know, when my
I'm gonna start traveling, but it's all right. I'll let you know.
All right, thanks, Ira.
Okay, all right.
That's always you're the best. Thank you.
All right, and good luck with the surgery.
Yes, thanks. I'll need it.
Okay.
All right, bye-bye. All right, everybody, I'll see you back in Discord. That was a good conversation. I've got, I already posted the article that I had sent me. So make sure you copy and paste it, save it. I'll see you all back in Discord in a second.